And I'm waiting, and we are live. Okay, so good. So I'm here with Lawrence Blau and Lindsay LaFleur. Did I say it right?
You said it great.
So just for anybody who's listening, because it's such a cold day, this is the hat factory in Old Building, so you'll hear like the clank, the old heat system go off. So apologize to anybody who's listening. So I'm here with Larry and Lindsay, and they are. I'll just say, like, you guys are tax professionals and financial. I don't want to say advisors, because we'll get into difference between. There's some big words that I want to discuss, because I know there's different types of advisors and financial planners. But here's how I'm going to intro, and then we can just talk, okay? Because this is what I was thinking about this morning. When, like, nowadays, so much stuff is on the internet, so much information is out there. Like, if somebody wants to build a cabinet, they can look up, they can do it themselves. If somebody even wants to make a video, they can buy a camera, take some online classes, figure it out. So I was thinking about taxes, and there is no DIY with tax. You can't do it yourself on taxes, even if you think you know something. Would you agree with that?
Well,
I've sat down and tried to, like, looked at a tax form and been like, I'm silly if I try to do this myself.
Well, you could really do it yourself, but why should you want to do it yourself? People spend money on stupid things. Why not spend some money and really get it done right? For most people to have a competent and knowledgeable person do their tax return isn't a lot of money. It's not going to change your life if you seek somebody out, and it's very possible that it may benefit you long term and short term. So I don't see why there's anybody who would want to do their own tax returns.
And
Right.
I also think that this misconception when the new tax bill came into play, which we'll see this year, was that, oh, it's super easy. You can do it on a postcard. And that was sort of how it was marketed.
Right.
And that's actually further from the truth. It's actually harder. The number of pages that a complete tax return is almost double under the new tax law as opposed to the old tax law. So if you think that you want to do it yourself, that's great. But, if you put something on line 22, for example, that should be on line 17, I am going to tell you the IRS is going to catch you, and you're going to get a letter from the IRS saying, please explain this. And nobody wants to get a letter from the IRS. At least in our client's opinion, when they get these letters from the IRS, they get such a relief because they just call us and they handle it to us and we sort of take care of it. But I think having someone who, is trained and knows what they're doing makes sense in this kind of situation, because I think one place you really don't want to mess with is, the government. And by putting something in the wrong line on certain forms or misclassifying things, you just open yourself up to a lot more scrutiny.
One of the scariest things to get is a letter from the IRS, because you just know it. Like the envelope looks different.
Yeah. And it could be as simple as, like, they couldn't read your handwriting.
Right.
Right. But the way they'll say it is not, hey, we can't read your handwriting, do a little better. It'll be some jargon that most people won't understand. And, that's where you sort of get into it.
So how do you, are you guys privy to just, I guess, certain information? Like you mentioned there's changes, and there was definitely a pitch last year that we were going to simplify the tax process, right? So what I'm not asking you guys to give away any specific advice, because I guess you probably can't advise generally, because you have to know the specific situation. But what are some of those changes?
Well, the new tax law was simplified to the extent that individuals who file tax returns, many of them today are going to use the standard deduction. Many of the lower income people are not going to itemize anymore. Personal exemptions have been eliminated from the tax return. So that's also easier. There will be no more conflicts of who should claim a son or a daughter, if there's as if there's a divorce situation. So then for the simple tax return, that is correct. It is simpler, but it's not simpler. I'll give you an example.
And Larry, just move up just a little bit more. There you go.
A state doesn't have to follow federal law.
Okay.
It's not mandatory.
Right.
So many states do not follow federal law. New York this year is not following federal law in relation to an individual's itemized tax deductions. So as an example, miscellaneous tax deductions for a Form 1040 includes things like a tax preparation fee, investment advisory fees, employee non-reimbursed business expenses, all kinds of other write-offs which do not fall into the other parts of the form. New York State lets you use that as a tax deduction. So even though you may not get it on the federal return, you would probably get it on the state return. New York State is one of the highest taxed states in the United States. So it's simpler for a very simple tax situation. It is not more simple for many of our clients, and for many of the businesses that we handle. I have spent numerous hours questioning certain sections of the new tax law. I have taken courses, I have read books, I have spoken to people. It's not as simple as the current government has presented it. So I think that people will be what do they call it? Petty foolish if they do not seek out a tax return preparer who knows all this. Now, let's also talk about a competent tax return preparer, because there are a lot of people who just,
and Larry, just because you're saying, like, if you don't use somebody else, does that mean you're not? How do you guys phrase it? You're not maximizing the full benefits? Like, it's not like we're trying to hide money, but there may be something.
Well, I mean, we often get even clients who will go to either do it themselves, or they'll go to other places to do the returns, and
like a cookie cutter
type place. And then they'll come to us and maybe there'll be a new client. We'll say, okay, let us see your previous year tax returns. And they would have gone to this cookie cutter place or done it themselves, and they'll show it to us. And we're like, oh, we wish you would have came in here last year, because we could have helped you out and saved you money here, or maximized something here.
Like, you didn't know about this tax incentive or this tax,
or when we have a conversation with them to understand what their intent perhaps in doing either a business or what they did, it wasn't, maybe they didn't have that same conversation with this cookie cutter place, or maybe it was misconstrued, or maybe it was rushed forward. And then we'll look and we'll say, oh,
well, I'll give you an example.
We could have helped you a little bit more last year, but this year we're going to set it right. So you either maybe lost money last year in that situation
that you didn't even know about.
Yeah, that you didn't even know about. So, sorry to tell you about that now, kind of thing. But we're here to help you now. Or they've gotten questioned by the IRS, and the cookie cutter place is a seasonal place, and they're not open anymore.
Right.
So,
well, I'll give you an example of a situation that happened about a few years ago. We picked up a I'm a new client who was a California resident who was moving to Seattle for their business, and the couple were using a CPA firm in San Diego, and there and the husband's company did not reimburse them for their moving expenses. So the tax return was done by the CPA firm, and they decided to leave them and of course come to us, even though we're located. I'm in New York, and when I looked at their tax return, I questioned them about the moving expenses, and their comment was that their former CPA never even brought it up. And I said, well, I don't understand why.
And even to me, that seems like an obvious thing.
Well, yeah, but you don't know who's really doing your tax return and what their level of knowledge is.
Right.
I think that
and how
comes
much
to,
time
like,
they're putting into it.
Sorry to interject here, but I think that comes to a different point in that when you go to these bigger firms or these cookie cutter firms, you may not necessarily be getting someone doing your return who's knowledgeable and skilled. You may just have them signing off on your return, but
Right.
you know, we're a little different in the sense that when you call us, you get us. We don't have any sort of handlers. We kind of do it all, which
No,
is
and that's
a little
great.
bit of differentiator.
I think personalization is so important in like whatever your business you're in now, because people got so annoyed. Like, I don't think they do it anymore, but like the corporate, like you call up like a big corporation,
Yeah.
you're pressing buttons, you're not even talking to anybody. And I think people are very frustrated by that.
Well,
and you think if you go to like a cookie cutter place and they're just charging you $50 to do your taxes, like you got to think about, for that place to make money now, how much time can somebody really spend doing your taxes? And
Well,
you do miss out.
Well, first of all, let's get back to this situation
Right.
which I presented. And what I wound up doing is I wound up filing an amended tax return for these people, claiming the moving expenses on an amended tax return, and presenting it to the government in a certain way. And it was accepted by the IRS, and these people got a nice refund check.
Nice.
So one other thing that I've learned many things in my 45 years of close to 50 years of doing tax work. One of the things that I always follow is that if I have a questionable position on a tax return, I will take the assumption that the government is going to look at it, and I will send the government all of the documentation with the tax return and a full narrative of the situation. In my many years of doing this, it's always worked for me. You know, as an example, I had a client maybe 20 years ago who lived in Long Island, and he had a dock on his back of his house where he would dock his boat. Well, one winter, there was a bad winter, and his dock was wrecked by freezing ice, and his insurance company would not cover it. Well, he then had a casualty loss, and the way that you measure the casualty loss is the difference between what the fair market value of the property is prior to the loss, and then what it is after the loss. Well, when I did his tax return, I sent a full narrative of what happened, pictures, appraisals, all kinds of things. And the loss was a couple of $100,000. And I believe that if you're upfront with the with the government in certain situations, then it will work to your benefit. So let's also talk about.
No, you made me think about my uncle was telling a story, and I don't know if this is relevant to taxes. It's just you're talking about being upfront. And my uncle went to buy a new car, and he had a check. I think it was like, let's say it's a $40,000 car. He had a check for $20,000, and he brought in $20,000 cash, and they wouldn't take it. They wouldn't take the cash. They said, go to your bank, deposit the money, and then give us a check, because they needed to know where that money came from.
Yeah. Yeah.
And that, I don't think that was true 20 years ago. You could bring in cash.
True.
Oh, it was
true.
But just maybe more people were open to.
If you bring in a 10,000 or more to a bank, they will not accept it.
Oh, is that right?
Yes. And I have another story about that, which I'm not going to get.
Well, it's so fun because I know the $10,000 rule, like, right? Yeah. I don't know what happens. So people deposit $9,999. But if you're trying to evade something, if you're doing that every week, like there's going to be a flag on that account.
Right.
I would hope so.
Right.
So now tell me the difference. So I'm curious about, because, I had to think about myself. I don't know if I have a financial planner or a financial advisor. There's a difference between the two, right? Because I know that also, like, as well as you do taxes, you also do financial planning.
Right. So what we are, we do financial planning. We're what they call fee only. So we charge a flat fee to do it. There's a big movement and a push. I would say most people are fee only financial planners, meaning you don't charge by the hour. You take on projects and however many hours it takes you. And usually these kind of plans, it's not a straight road, right? You'll go down one way and then they'll fork to 10 different ways. So that's sort of the terminology used, fee only financial planners. And what other sort of thing that intertwines with that is we're called registered investment advisors, or RIAs, and we're independent in the sense that we don't have an affiliation with any brokerage houses. We're not affiliated with Wells Fargo or Charles Schwab or TD Ameritrade or Morgan Stanley or Merrill Lynch. So we are bound by the fiduciary rule. So it's a little bit different than your financial advisor at Wells Fargo or Morgan Stanley or a brokerage house. We act in our client's best interest.
Right.
So when we
I think that's a key point. Explain that, because what you're saying is you're classified. I don't want to say a regulation. I don't know if that's the right word. But you can't just say, like, okay, this is a hot stock or whatever it is. Like,
no, we can't say, well, my boss, if I put for example, $500,000 in XYZ stock or mutual fund or bond or new listing, then my boss is going to give me $20,000 more in my paycheck.
Right.
We actually have to we don't have those kind of blinders on per se, because we're not motivated by incentives or commissions. We have to look and find the best investment for our clients and act in their best interest, not putting aside any motivations our bosses may give us, which is different than a financial advisor, where there's a big movement for independent RIAs, which is what we are, to manage money, because I don't know I can gander what the reasoning is behind that, but when you want someone managing your money and you truly want them to have your best interest. And this is not to say that your guy at Morgan Stanley or Merrill Lynch doesn't have your best interest.
But I don't even think people know that. That's
right.
What I mean. They don't know that they're giving somebody money and they don't have to look out for their money necessarily.
Yeah, there's a different nuance in the law there. So that's kind of some of the battle for us is to, when people come in and they think that their guy is the best, is, we have to, and we see their 1099s because we may even do their taxes. And then we look at it and we say, oh, wow, it's a difficult conversation to have because nobody wants to think they've made the wrong decision in something
right.
as important as managing their own money.
Especially their money. Right.
And then we sort of have to have this conversation about, a fiduciary and what we do and how we're different and, how we might manage their money differently. And most of the time, people are acting in the best interest, but just to know that they might not.
Well, just to know that they're binded, is that the right word? Binded by law to look out for your best interest.
Exactly.
I think that's important.
Yeah. And then the financial advisors and they call them FAs are not by law is, for some people is
I gotta talk to
alarm,
my guy.
Alarm bells sort of ringing out.
Right. So then is this like long-term financial planning? Because that's the other thing I was thinking about with you guys is I was telling my parents we have Sunday dinners. So I was telling them one of the things I wish I learned in school was just how to like manage money, the idea of saving, the idea of balancing your checkbook and spending things within your means. Like
Right.
in the last 100 years, I don't know if 100 years ago, you probably could not live outside your means. Like I don't think credit was as readily
Credit
available.
wasn't available.
Even banks, there
yeah.
was no ATM. If you took out money on Friday and that was your money for the
Well,
you had to wait in line at the bank.
The first credit card was a company called Diners Club, which isn't in existence anymore. And it was a credit card which wasn't widely accepted. And until all the banks got on the bandwagon, that was the only credit card. And
it was called the Diners Club?
Diners Club. And it was basically for people who went to restaurants.
Dad, did you have a Diners Club card? Because
Yes,
I think
I
I
did.
remember you did.
And in fact, your okay mother worked for Diners Club.
Wow.
So,
And what years do you think that was?
well, she worked for Diners Club in the late 60s, but I think the company started in the mid 50s.
Is that when they had that machine and they run it across? Like there was no electronic device yet.
Well, they didn't even have a machine.
Probably just
They
wrote
would
it
like
down, Jeff.
the carbon copy.
There's
You
no
remember that
carbon
slide?
copies. That's new.
They would just
That was technologically advancing at that
they
time.
would just write all your information on a slip because the world was a lot simpler then. You didn't have to worry about somebody getting your credit card information and going crazy.
Right.
People were more sincere. People did business differently. So many people used to, of course, were then forced to then live within their means because they would get paid on Friday. There would also be I was reading a statistic that the big growing field in the United States in relation to the business is self-employed people, or of course people working for themselves.
Mm-hmm.
That's greatly expanding, and there is more of a shrinkage in salaried employed people. And so
that I did not know.
Yeah. So people today tend to live beyond their means because
you can.
Credit is readily available. And
I get a letter in my mailbox, whether it's at the office or at home, about a new credit card, it's pushed upon people. And then you go, oh, I can get $20,000.
Yeah.
Not knowing that the interest rate is 30% per year. And then
kind of like this conversation also brings me back to what we do with, say, financial planning. Financial planning and investment management are, they're two different things.
Mm-hmm.
A financial plan can encompass a cash flow analysis. So like my dad was talking about, maybe you're spending more than you're taking in. And you can sort of extrapolate that down the line with all your expenses and your salary and things like that.
Because you could actually tell somebody, if you keep going at this rate, here's where you'll be in 5 years. And you may not like that.
Yeah.
Right?
Are you going to outlive your money is one thing. People
Right.
usually come to us for financial planning when they're sort of at a life event, right? They've had a kid, they're near to retirement, their investments haven't been doing well, they want to sell their house, they want to buy a house, they have grandkids they want to plan for. So a financial plan can cover many things, right? It can be simple cash flow analysis. Will you outlive your money? Are you in debt? Can we help you restructure your debt and give a plan and how you should best do this?
That's got to be so huge right now.
I mean, I think
there's some stat that like not even 60 or 70% of Americans have $1,000 in the savings account for an emergency. It's some crazy number.
So one of my dad's rules and his golden rule that he's sort of always tells people, because when they come to us and they want us to invest their money and do these things, our first question, obviously we'd like the business, but our first question to them, something he's sort of ingrained in me, is, do you have, and he's more extreme than me, do you have a year's worth of expenses saved in a money market account, in a checking account?
I can't imagine anybody says yes to
a year's
that.
a year's worth of expenses. That's the first question.
It's got to be a lot of no's.
I'm a little bit more aggressive in this sense. I do 3 to 6 months. Okay. And my definition of liquid money is a little different than his.
Right.
We're different ages. We've learned in different ways. But
yeah, I want to talk
and
about
then
what liquid money even means.
And then people will say, yes, they may come in with $1 million, and we say, okay, how much does it cost you to live a year? And that may be $100,000. And we'll say, well, okay, we're going to take $100,000, we're putting it aside, and it's just going to sit there. And they're going to say, well, why are you doing that? And we'll say, well, if something happens, and this is your long-term.
And that's not something you're investing with. That's just going in basically a lockbox, like a digital lockbox. And you're like, you can't touch it.
Exactly. Maybe we'll put it in something that will earn very little bit, but it's extremely safe, probably short-term investments, things like that. He's more extreme than me. He'll just let it sit in cash, which I've always been like, you just let something sit in cash, you actually lose money on a daily basis and over time. But, that's sort of another part of financial planning. A bigger part is asset allocation. As you grow and you move on in life and things change, your risk tolerance, or how much risk you should take on, it changes and it fluctuates. When you're younger, you should probably take on more risk, right? Because if you've got retirement money,
right,
you can withstand if the market loses 30%, right? But if you're close to retirement and the market loses 30%, you kind of just lost a ton and you don't have enough time to make it up. So a lot of times what will happen with people is maybe they've worked for 5 different places. So they have all these 401ks, they've saved some money, but they never actually changed the way that money was being invested from the day they started at all these companies. So it could be extremely out of proportion. And other things that can make it out of proportion is, if the investments you were in, if they lost or they made money, right, as something moves up in value, it becomes a bigger part of your pie. Sometimes they pay out dividends. So things are always in fluctuation. And that comes to investment management. You want somebody looking at your investments to make sure that you're perfectly diversified. You're not all invested in one position.
And like you said, life changes. Like life is not a constant. So you have to come back and look at it. I don't know how often, if it's every year, every couple of months.
I mean, we recommend that people do it if nothing major is going on in their life. It's sort of a health checkup, right?
Right.
We would like to say once a year. If more things are going on, once we sort of have you set up and you say, you might say, hey, I know you told me to sell my house because it's too expensive for me and I didn't get to it by 2018. So can we tweak and see what I need, where I need to adjust so I'm going to still achieve my goals. So it's sort of, that's financial planning. Investment management is the day-to-day monitoring and investing, watching the market, making sure that our clients' positions aren't, they're still set up to do what we've intended them to do. And that obviously, changes. And that brings me to another point. And there's a lot of volatility in the stock market and the bond market, and it's moved by many, many different things. People
I don't even know what are you checking that? They go, like yesterday, I was listening to some news and they were like, the Dow it closed yesterday. It's up 10 points. I don't even know what that means. Like,
yeah. I mean, a lot of these measures were from many, many years ago when, people followed 10 stocks and that was the barometer of the economy. But there's so many things going on now. And really, if you're a long-term investor and your exit plan is 10 years from now, you shouldn't be so concerned about, somebody firing off tweets that propels the stock market down or up one day, or,
right.
These kind of things. Because in the long run, the people who tend to lose money are usually have, a knee-jerk reaction to these things. And you kind of want to be able to stay the course if you're a long-term investor. If you're not a long-term investor, then you definitely, you want to make sure that your investments are watched by someone and on a daily basis, so that if there is something.
Because they don't have the time for that.
No, they don't have the time for that. No. I mean, I pay someone to do that for me because I'm watching my clients.
It's just interesting to hear lately. You just mentioned like the stock market used to be an indicator of the economy. So it's interesting to hear people say now that they don't necessarily match. Like even though the stock market, and I don't know if you want to get into
Right.
this, but the stock market going up is not a reflection that the economy is improving.
No. So generally what the economic data that comes out is backward looking, right? So it's very easy to understand with like, a stock, right? So you're going to hear Apple or whatever XYZ company is coming out with their earnings after the bell. The smarter money and the people who are the research analysts for Apple, all of the anticipation and all of the earnings, they're already built into the stock price, right?
Mm.
So really when the earnings come out, when you see, the stock goes up 5% or down 5%, that's sort of a temporary thing. It's really in the management, the words that they come out and say for their forward looking, because everything that's built and news and numbers that's built into the stock that's trading is actually based on readily available information, right?
Right.
So there's nothing necessarily happening now that would, propel it.
Right.
It's all sort of behavioral.
So you mentioned before liquid money. Is that different than money? What is that? What do you mean by liquid money?
So liquid money is if you invest in you buy a house, okay, and something terrible happens, and you need the money that you bought the house with, like in 3 days.
Mm-hmm.
Are you going to be able to get that, Jeff?
No.
Right, because you got to go sell the house.
Right.
It takes a while, right? So real estate are not liquid investments in the sense that you can't get your money out of it generally immediately, right? A stock, like if you say, I want to buy GE, here's $100,000. And then tomorrow you call me and say, oh man, something happened. I need my $100,000. I say, no problem. I'm going to sell it right now and you're going to have it. And then you could get even more granular, right? So it could be, I don't even want to risk. I want to make sure I always have that $100,000. So I'm just going to let it sit in cash, right?
Mm-hmm.
I'm not going to invest it in a CD because what does a CD do? It actually holds your money, right? For they might say we'll give you 1% in a 9-month CD. But I can't get my money until 9 months is up, unless I break it, and then there'll be some big fees. But things like that aren't generally liquid, where you can't get your money right away.
The house investment aspect is interesting because I don't know how you both view a house as an asset or an investment, but it sounds like that is also changing, where definitely like I can still hear my dad saying like, you need to buy a house. You need to like invest your money in the house,
Right.
meaning over renting. So I understand that term, but so like even my girlfriend right now is considering selling her house because she's basically doing like her own financial assessment on herself and like, what is this really costing me? Is this above my means? How much money do I have to put into the house over the next 5 to 10 years? Is it better for me to sell it, downsize? I don't know how you advise people on, if you can talk about it in a general sense, like what the house really means in terms of your financial goals.
Well,
I think it's a 2-pronged questions, really.
Right.
Right.
Yeah, I may not be asking the question right, so you can
I think,
rephrase it.
I mean, what we've always told people, real estate as an investment or real estate to live. If you're not a real estate, like if that's not your profession, right? And you view yourself as, I'm the real estate guy and I'm going to have houses and I'm going to make money off the houses. Like that's your profession, then that's great.
Great.
Right. And then, I've always been raised that, you buy a house because you want to show that you're paying for something and earning something rather than just giving it to a person to sort of rent. Right.
Right. And my dad used to say that's good debt. He doesn't used to say, he still says it. He's like, it's good to have debt. And I used to be like, what?
Well, let's also talk about something else that there are, people have very short memories. Let's go back to the year 2008 during the real estate crisis.
Right.
Why did it happen? What happened? So, real estate.
Come closer to me, but actually physically, because that chair's on wheels.
People people used to look at real estate under the assumption that it will always go up in value.
Exactly.
It will never decrease in value. That was the common perception. Well, 2008 rolls around, and real estate values fell, some of them more than even 50%. So what also happened is there were quite a few people who got mortgages who did not, who shouldn't have gotten mortgages. So once the value of the real estate falls and their mortgage is then based on a different market value, the banks started to go into a real panic. So the real thinking about real estate is that what are you going to use it as? Are you going to use it as your personal residence, or are you going to use it as investment property?
Mm-hmm.
We always advise people who are not real estate professionals never to look at a piece of real estate as an investment. You aren't guaranteed that it will always go up in value. Real estate has other problems.
And the 2008 example is perfect for that, because a lot of people lost money on that.
Lost money, and it really
And they're still in holes from that.
Yeah,
maybe they bought a house for $800,000. They have a $600,000 mortgage, and guess what? Now it's worth $400,000 still.
And especially if they
right?
did like a reverse mortgage, right? Those people are in trouble.
Well,
right? Because if you took out money based on the value of the house at the time and then it depreciated, that hurt, right?
Yeah.
Well, the other thing was there have been a few lawsuits settled recently from the 2008 real estate crisis, which are pretty interesting lawsuits. Some of our larger financial institutions were sued on a class action lawsuit by mortgage holders who were given mortgages who shouldn't have been given mortgages, and their lives were ruined. And
I mean, they were doing like no money down.
Oh my God. No income verification.
But I mean, I think,
and there was like small business owners who, like you said, they didn't have to verify income, no money down. Of course, as somebody who wants a house, I'm going to sign up for that.
But I mean, this problem is reappearing itself again.
Yeah,
they really haven't learned
in the housing market or in something
in
the mortgage market.
In the mortgage market, it's starting to.
There's other ways
again.
that.
Why is it appearing again? Greed. Okay.
But how? I thought the regulations were
because our financial institutions give you a mortgage, they then make fees off that mortgage, and they wind up selling the mortgage. They don't hold the mortgage.
They can still do that.
Yeah.
Right.
Yeah, they wind up selling it. So
and you get into that derivative conversation, which is way over my head, whatever that means.
That's my head. I get that one.
They don't care who is paying the monthly mortgage payments, and it ruined a lot of people's lives, and we still see ramifications of that. What I want to talk about are another few.
Can I just interject on one thing?
Yeah.
On houses and the need to own them. I mean, we definitely think that that having
it's better than renting.
It's definitely better than renting if you can afford it, and it's a good price. And it will kind of tie back into financial planning. Sometimes we'll get a client in and they want to do a financial plan, and they're so hung up on this concept of net worth. They want something on paper to say, I'm worth X, $7 million or $100,000, and we'll explain to them our views on net worth. Your assets, right? What are your assets, right? So that's
is it just increasing net worth to brag about it? Because you can't touch it, right?
So the way we view assets, right? Homes, right? We don't like my dad was alluding to, we don't project that your home's going to grow by any rate, right? So if your home today is worth $400,000, guess what? In our analysis, it's worth $400,000 in 30 years. Okay. So that's your
It's the
asset.
most
Just because it's
conservative
unpredictable.
approach.
Yeah.
I'm not going to value real estate as the same as I value various other assets.
Right. We can
Okay.
take your investments and say that, you know, under normal distribution, you should get an average rate of return because you're investing this way and someone's watching to make sure you continue to invest in this way, that this portfolio will grow at 4% or whatever it is. So in 30 years, it should be worth this. This doesn't mean there won't be any sort of black swan events where the market could go down 30% and normal convention sort of goes out the window. But this is what it should be worth under something that we have to be able to hang our heads on is, you know, it's going to behave in a normally distributed way, right? But things like, so then you'll get to those are your assets, gold, things like that. You know, cars are depreciating asset. So people may say, I've got 5 cars. You know what? When you buy a car, this is as soon as you drive it out of the dealership, it's worth less. Every day it's worth less. And we advise our clients not to buy depreciable assets. Okay. So we have all these things that make up assets. Then you have liabilities, right? Mortgages. We could even put things in, you know, you're going to need to send kids to school and you don't want them to have the debt. So that's going to be your future debt. So all these things, assets, minus all your liabilities will equal your equity. And for some reason, that's important to people to see what their net worth is. And for us, that concept is kind of like, well, it doesn't really mean anything. And it's kind of like a paper term, which you know, comes back to this whole thing about my house is worth this. Nothing that you have is worth anything until someone is willing to buy it at that price.
That's true.
Okay. So your Mickey Mantle picture or whatever it is, you may think it's worth his signed picture or his glove or this, but it's not worth anything until someone's willing to pay you for it.
I was so mad. I have a rookie, Ken Griffey Jr. He's probably the 6th best baseball player of all time. Signed rookie card. I thought it was going to be worth a lot of money.
No, like the baseball card industry. Well, what happened in the baseball card industry? That's a whole other.
So mad.
A whole other.
That was my retirement
issue,
plan.
Right? That's a whole other thing. It's almost like this idea of money, right? How are we funding our deficit? We're just printing more money. And someone's willing to buy it, right? So we're just running the printing press. Baseball cards, we're just going to print more baseball cards. So there's not a scarcity of Ken Griffey Jr. rookie cards because they printed as many as they wanted. So when you bought all those packs of cards and you got your Ken Griffey Jr., there was no constraint on how many Ken Griffey Jr.'s they could print.
That was like 2 years ago. I got really sad about that.
Yeah, the baseball cards are worth nothing. Sorry,
I just
Jeff.
want to talk about some other concepts. Number one, we've had people come to us and say, well, my stockbroker did 40% last year. Let's just say an example, and the market was up 30%. And I look at them and I say, well, that's good, but how much did your stockbroker do? What did your stockbroker do when there was a down year in the market? I don't.
Right, because anybody can do good when things are going well.
When I look at an investment,
I hope so.
Is that the point? Right?
Yes, that's the point. And you know, the other point is that most of the world looks at investing or certain investments that they're looking at. How much can I make? And I look at all investments. How much could I lose? I don't care what I could make. I want to know what I can lose. So it's a different approach. I've passed on some investments that have worked out very well for other people due to that. And it's always kept me out of trouble. Okay. So
I mean, I think to my dad's point there, I mean, there was a point last year in global markets that you could have just taken a ball out of a pit and thrown it at the wall and you would have made 5% that month. It didn't matter what you did. Right. But when we get to
just because everything was trending up.
Yeah. And when we got to the end of the year, that was a little bit more difficult, right? It was more of, did my guy who did so well, did he protect me to the year end, or did he still did he put me on the snooze button, or was I still going 100 miles an hour?
That's got to make people feel safe with you, knowing that you're more concerned about the risk than, trying to go after a pipe dream where I'm gonna double my money in a couple of years and
We've
that
had
sort
a
of
few
thing.
people come in recently who, they'll hear about a particular industry that's hot now, and the government's getting involved in it, and they just, it's almost like a gold rush.
Right.
And they don't necessarily have a lot of money, but they want to make a lot of money. Well, and we'll say to them, well, this is a very volatile industry. There's not many liquid investments, meaning you could also have an illiquid stock or an illiquid bond, meaning you could buy it, but you can't really sell it so easily because it doesn't necessarily trade. There may be reasons it doesn't trade, that the stock is locked up, meaning institutions have it and they can't sell it yet.
Mhm.
Or it could just be a small market, right? So they'll come into us and they'll read whatever headlines or something, and they want to take their $20,000 and they saw some, you can make 20, 30, 40% in a few months. And we'll say to them, well, are you willing to lose $20,000 in a month or two? And obviously, no.
Mm-mm.
Well, I'm not going to do it for you then. I'm not going to give you the slim chance of making that, because the reality is you could probably lose it all in a few days.
I imagine you guys say that to
Well-
people sometimes. Not no, but we that's not a good idea.
Well,
Not
Well-
just to take, because some people would just take the money and say, yeah, we'll try it. But I don't think you'll do that.
well, a few other examples and a
We
few
won't
other
do that.
thoughts
Just
about
making sure that's on.
Verify that.
and a few other thoughts about risk. Number one, there are many people who say to us, well, okay, I heard of this bond that's yielding 8%. And that's a great yield. And what they don't understand is that the higher the yield, the higher the risk. I don't care. We need to know what that risk is. Who is the person selling you that debt? What is the company? What is their financial situation? The higher the yield, the higher the risk. Further, talking about risk, in proper financial planning, there is something called risk tolerance. What that means, and that's a critical feature of proper financial planning, and it is taught in the financial planning courses to be a certified financial planner, and there's a lot of time spent on it.
Mhm.
And we spend a lot of time on it as well. What it is that it is tailoring your investments for your risk tolerance, meaning that how much risk can you live with? Okay.
There'll be like a questionnaire we'll give people, and we'll say, if you were to lose 20%, how quickly would you change your investments? And it would be, bubble A will be like, I would leave them. Bubble B would be like, I'd give it a year. Bubble C would be like 6 months, and whatever your answer's in, it would sort of aggregate into, a weighting.
I'll give you another example. We have had people who are 30 and 40 years old come in and they don't want to take much risk, meaning that okay, their then asset allocation should typically be more riskier than if you're 60 or 70, but if their risk tolerance is so low, then you have to tailor their investments towards the risks that they are willing to take.
So onto that point, we sort of give our clients, I could look at you and I could say, I know how you should be invested. I know what your risk tolerance is, and we'll give you a questionnaire, and you'll fill out the questionnaire, and that will give us some indication of, your biases and how you score on it. And I might say to you, hey, hey, Jeff, you failed. You are not this. You should be this. And these are the reasons why. And then we'll have that conversation.
It's like a financial health assessment.
Yeah. And see if you're okay with that. So another thing that if we get into more financial planning and because my dad brought up, if you're 30.
I thought we were going to talk about taxes a lot. I like that we're talking about financial planning.
Well, I want to get back to taxes.
Yeah, no, I want to talk because it's such a good time of year to talk about taxes.
Last thing then here in sort of investment management and financial planning, a thing that I don't know if it's aged but what I find with sort of millennials and people from say 20 to 40, 45, one of the things that I have advised that sort of generation, and I do it myself, is something called forced savings, right? You may have kids or you things you have student debt or things like that. So what are forced savings? And there's some people that'll come in and we don't know them that well. So we don't know their habits. Like if we leave $100,000 in their checking account, are they going to go buy a Tesla? Right. There are people like that. Right. But if we leave $20,000 in their checking account, they might think that they have to sort of, count their pennies and it can, there's different extremes, but what are forced savings, right? So for example, I have, 3 kids. They're all going to need to go to college, right?
I was going to ask you, what do you think it takes? I've been debating people in my family about this to raise a child from point of birth till 18 years old.
Like
what do you
in
think?
Money or like mental power?
No. I don't know if there's enough mental power.
There is no number that you could use that is high enough. It is based upon how you want to raise your child.
Because I'm talking about the taxes that you spend on, whether it's school taxes. I mean, if you
Well-
own a house, you're paying that anyway. The insurance, the saving up for college, extracurricular
Well,
activities, food,
right
diapers.
now-
$1 to $3 million a kid.
Yeah.
So I said to my parents 1 million, and they said that's just not possible. And I said, like today, if you were to have a child, there's different ways that you could probably, maybe make that less, but a good life, I think, would be $1 million. And that
More than $1 million.
It's all relative. I mean, my kid's version of a good life is I can guarantee you my parents didn't do any of that for me. They did a lot of other things, but it's all relative, right? There's different versions, right? And my kids may look in their town and say, well, these kids are doing this. So I think it's really all relative. I think
I was being low. I said $1 million. You're saying it could be up to $3 million.
Well, I mean, college right now, if you go to a 4-year school, you have to have $200,000 to $300,000.
That's right.
I mean, that's in today's money, right? So then extrapolate with inflation and everything. But let's get
Since
back.
I graduated college, my tuition was $35. It's now up to $48. That was 12 years ago.
Now you
Do
get
you
up
know
to
what
70.
my tuition cost a year?
$300.
I graduated in 1971 from Brooklyn College. It was $50 a year.
They paid me to go to school though, so I wouldn't.
There you
So-
go. Because he
so-
planned.
Yeah.
So,
Wait.
So
Let me
sorry,
get back
yeah,
to
sorry.
forced savings. So
Yeah.
what is forced savings? Okay, I think I have seen, and there is a piece of the younger generation that if I don't see it, if I don't do it, and it just sort of happens, i.e., every month on the 31st, I take $400 and I put it into each of my kids' 529s, and it just happens,
Mhm.
right? So that's sort of forced savings. Or
You almost treat it like a bill.
It's
sounds
a bill.
like. Yeah.
It's a bill, and then it just happens automatically.
And
It
it
comes out
becomes
of
a
my
habit.
paycheck, and then at the end of the year, I say, "Oh man, I saved I put $7,000 in each of these kids' 529s," or I have a mortgage, right? And I went to my financial advisor, and I had them do the math for me, and I saw that if I'm paying an extra $400 in principal each month, it's going to lower my mortgage. The payoff by 2 years. So I'm going to make that automatically happen.
Mm.
I don't want to be involved in it. It's just going to happen. So there's forced savings or I'm going to pay off this credit card debt and I'm going to do $100 extra a month and it's automatically going to happen. These little tricks and forced savings, they actually have huge ramifications because we've also seen the other spectrum where you've got a client who, he may make a decent amount of money, but he doesn't save it all, right? Whatever comes in, he spends it and he lives kind of high off the hog.
Mhm.
But he's got kids and they're going to go to college in a few years. And we say, hey, what are you going to do about your kid's college? He said, I'm going to figure out when it happens.
Wow.
That scares me. And I'm not even him,
I don't even know him and it scares me.
right? So I think
Because I made that mistake waiting. I was 18, then I got accepted to good school. And then it was like, how are you going to pay for it? and then they just gave me money.
Yeah, but I mean, I
It's
just
scary.
there's little things like that we always are advising our clients
Yeah.
to do, just to, take some of the pressure off and to make things happen, because there are some generations that if the money's there, they're just going to spend it, and saving a little bit now and being forced to save could have really great effects later.
Well, you're definitely going to fight the YOLO mentality.
Yeah, exactly.
You only live once, Larry. So
He does that too. That's his favorite.
all right. So taxes,
Okay.
because tax season is coming up.
Yes.
Okay.
Right. So for
Sorry.
businesses, I know, like, I got to figure out stuff by March 1st or March 15th.
Well,
The rest of the civilians out there, April 15th.
Taxes are, all personal tax returns are due by April 15th unless you get an extension. There is a misconception what an extension means.
And you educated me on that.
What an extension means is to file the forms. It doesn't mean
You still have to pay.
you have to pay.
Yes.
So
An estimate, and you have to get a reasonable estimate.
But you're right. I mean,
estimate.
people think that
Now,
an extension
but
means I don't have to pay.
What could happen if, let's say, you figure that you owe $20,000, you don't have the money, and you're going to get an extension? Okay, what's the right thing to do, and what's the wrong thing to do? First, let's talk about the wrong thing to do. You fill out an extension form with no money due, and you send it in.
Mm-hmm.
Wrong.
Government's going to say, "Where's my money?"
No, they're not going to say anything. Why is it wrong? They don't know that form is wrong until you file your tax return.
Oh,
Okay.
okay.
So here's the reason why it's wrong. Because one is that there is a 5% penalty per month, maximum 25% on late payments. Okay.
You just said max 25%. You mean for the year or for the month?
For the amount due. So if you owe $20,000 and if you pay it in October, you got a $5,000 penalty.
Ooh.
Okay. Non-deductible. Now, let's also now further, it subjects you to another penalty for not having a valid extension.
What makes it valid?
Paying the amount that you should have paid. Why should you be given an advantage over the same guy who owes the same $20,000, who files by April 15th and pays in the $20,000?
You're saying that as the point of view as the IRS.
Yes.
Right. Yeah.
You should have no advantage over that other person. So it's conceivable that first of all, they will automatically assess you the late payment penalty. That's a given.
Right.
Second, they could also assess you another 25%. For not having a valid extension and for late filing.
So now you're up to 50%.
Now you're up to 50%.
That's 10 grand on this $20,000
$10,000
example.
on the 20,000. So
I guess the point of the matter is, if you think you're just going to be
no,
lazy.
let me finish. So the same person comes into us on April 10th and says, "What should I do?"
You got 5 days to figure it out.
You got 5 days. Here is okay what I tell them. You have to file by the 15th of April. You don't have a choice. Let's file it and not pay. Okay. First of all, that will then knock out the
25%.
One of the 25%.
Right.
And there is a special form where you can request a installment arrangement in order to pay it off on a monthly basis.
Well, when you get those letters from the IRS, they tell you that.
Yes.
You can
Yes.
be eligible for that.
So
But
then
people don't read the letters.
Here, Jeff.
People don't read the letters.
Yeah.
I read them when I get them.
so then I always advise people not to go on extension unless they are just lazy on gathering all their tax information, or they're waiting for a some information from an investment, which is going to come later in the year.
Mhm.
So all calendar year corporations are also due by April 15th. That due date changed a few years ago. All calendar year partnerships and calendar year what we call sub-S corporations are also due on March 15th.
Right.
Okay, not on April 15th. They used to be on April 15th. Those also due dates have also changed. So that then leads me into a new section of the code, which was brought in by the new Tax Act. I have spent globs of hours learning that section of the code by rote memory. And I could tell you that it is not an easy concept. And okay, I'm going to talk.
And this is the first time. So it was passed last year, and this is the first tax season.
Year that it's going to be affected. And I could tell you in very simplistic terms what it is. There has always been a taxpayer conflict on why do corporations have lower tax rates than individuals. It's always been it's been a very hot topic for 100 years. So
do we have low corporate taxes in this country, or
we have low corporate taxes in this country? We also have low.
That was before the change. It was even considered low.
Yes.
Okay.
And we also have low personal tax rates in this country.
Even if you're in New York or California?
Yes. When I started in this business in the early 1970s, the highest tax rate was 70% federal.
Was that Jimmy Carter days? Was
that was before Jimmy Carter?
That was before.
Days. 70%. Okay.
But so now the argument on that, and it's not to get into this, but I remember, because this comes from my parents, but they said, but your mortgage was 21%. Like, so they said it was reflected in some, I don't know if that was just coincidental.
No,
that's always what I heard.
No, it's not. But okay, let's get back to this new tax code. So then what this new tax code is now trying to do is it's now trying to, equalize corporate tax rates with, certain income that you receive through companies which could be taxed as a corporation. So some of those things are: one is a partnership, two is a subchapter S corporation, three is rental property that you own yourself, four is royalty income that you receive, five is a self-employed income. So what the government has done is this new code section has now tried to equalize all of your income from those kind of what they call pass-through entities with corporate tax rates. So
are you talking about offshore accounts?
No,
that's another
I'm talking
conversation.
about
Okay.
everything,
Right.
everything in the United States. So
this is the simple version.
So
I'm already confused, and it's the simple version.
So if you are a self-employed individual filing a Schedule C, you would be subject to this new tax act.
Okay.
Okay. So it's going to affect a wide range of people. Okay. At least half the people filing tax returns will be affected by this. So what it does is,
and when you say affected, doesn't mean bad or good.
No.
It will impact
changed.
them.
No, and it is to your advantage. It is not to your disadvantage. So
as long as you follow the rules.
As long as you fully understand what to do. So what you would get is is a tax write-off on your personal tax return for something called qualified business income. Now, qualified business income is further defined by the government to be two different types of income. One is just regular business income, like a contractor,
Mhm.
and then there's something else called simplified service income. What that is if you make your money based on your reputation. If you are an accountant, a lawyer, a professional, a performing artist, a consultant,
A film producer.
No, not a film
What?
producer, not a film producer. So
Video producer,
not a video producer.
Huh.
So
video maker.
nope, not a video maker. So
Podcaster.
nope.
This is
So
messed
You're
up.
So if you make your money in certain specified,
Hold on, comedian.
yes, comedian would be
Boom. I'm in.
Yes,
certain,
there you go.
but then there are other restrictions or other rules for this tax write-off. So I really advise people that
Don't do this by yourself. For
not
one.
to
You
do
can't-
this
you-
by
you-
themselves.
Nobody can know
because-
that on their own.
because also you can restructure certain investments that you have to then maybe give you an advantage under this. Okay, I'll give you an example. Let's say that you have rental property.
Mhm.
And normally, if you do not hold your rental property in a corporation or in a partnership, then you would,
Which is not a smart thing to do.
well, you could also hold it in an LLC, and you would then have to, and if you are the sole member of the LLC, then you would report it on a Schedule E on your tax return, and then you would wind up paying tax either on the net profit or possibly get a tax write-off for a net loss.
Because if it was just in your personal, you couldn't write off expenses with that rental.
No,
Is that the
no,
idea?
no.
Or
No. You could only write off. You can claim as many expenses as you want against your revenue income,
even without an LLC or
even without
okay,
an
okay.
LLC. But if you are what they call a passive investor, then if there is a loss, then that loss is then carried forward only to be used against passive income
On the same, based on the same dollar, the same industry.
on the same nature of investments.
Right.
So if let's say that you have a rental property which is being reported on Schedule E, and there's a loss, and if you are a passive investor or if there is a profit, then to qualify for the qualified business income tax deduction, you must work in administrating this property at least 250 hours a year. If you do not, then you don't qualify for that tax write-off. But if you take the same piece of real estate and put it into a corporation and then make what they call a subchapter S election, you would then qualify for that qualified business income tax deduction.
You know, the other reason to use you instead of doing it yourself is I know that my brain only has a certain amount of processing RAM, like a computer. I don't want it to be filled up with this E-class sub S corporation.
So
I don't even want to think about it.
so by just saying this, I just hope that people look for somebody who is knowledgeable in all fields of the tax area, and then how it would impact them. Now,
It sounds like I have to do 250 hours of stand up this year.
Now there
to get this QBI.
No. Now there are ways that there are things to look for a qualified tax return preparer, which I wanted to get in previously, but let's just talk a little bit about it now.
Okay.
One is that person going to electronically file your tax return? According to
Don't tell me that's a bad thing.
According to New York State law,
that's what my accountant does.
If you prepare more than 10 tax returns for compensation, then you must electronically file, and the IRS follows suit. Now,
and furthermore, you're penalized,
and you're also penalized
when you e-file.
No,
if you don't, right, okay.
No, if you don't,
and
you can possibly get out of it by filing a reason. But also, how does this tax return preparer do your tax return? Because if, let's say that one of their other clients gets looked at by the IRS and they're making up write-offs or making up numbers that can't be justified, then the IRS has been known to then go into tax practices and then look at all of the client's tax returns.
Like, where else did they mess up?
Where else have they done this?
Yeah.
Further, you want somebody who is registered with the IRS. Now, there are a few ways. One is you could be a CPA, or you could be what they call what a registered tax return preparer. I am a registered tax return preparer. If you go to the IRS website, and if you want to know who is qualified in the Westchester area, my name's going to come up. I take 30 continuing hours of education courses a year in order to have that. Don't assume that all CPAs are tax knowledgeable, because they're not. The CPA profession is broken into a lot of different areas, and just don't make that assumption. Further, further, if you're going to go to a large chain sort of operation, I would not recommend that, because you don't know who is sitting opposite you, what kind of advice they're going to give you, and their availability during non-tax season is non-existent as well. So
like you said before, it's very seasonal.
Yeah. So
I mean, that's usually when the problems arise. Not during tax season.
Yeah.
And you actually said something. So when we were making videos for you, and this is still in regard to taxes, I think, Lindsay, you had mentioned it, where somebody came to you and said, oh, my account was so great, I just got a lot of money back on my taxes. And you were basically like, why would you lend the government money?
Yeah.
What is that?
That's like a sign of to me.
Because people get excited.
I've been taught, from my dad and in school, is that, if you got a big return, you didn't plan well, right? You've been lending the government money all year.
So explain that, because I heard you say that and it made sense on like a 20,000 foot level, but I was like, I don't understand what she really means.
The most basic example is if you're a W-2, you took the wrong exemption, right? So they've been taking out too much money, right? From what you could have had.
That's money could have been in your pocket.
It could have been in your pocket.
That you could have been investing.
You could have invested. You could have done whatever it is. By giving it to the government to hold and just give back to you later, it did nothing.
Because they were probably investing.
So you actually lost money, right? Because the value of money today is not the value of money tomorrow. If you do nothing with it, it's always worth less, right?
Right.
Due to inflation and things like that. So,
So does that mean when you do your taxes, you should get no money back?
You should get zero back.
that's
should get-
ideal. I've actually seen my
or
dad
there
get
should be-
excited when
or-
it's so close.
Or there should be a small
see
balance
that.
due. A small balance due. That's the best situation. We do a lot of tax planning
Yes, that's
towards
exactly.
the end of the year. The last 2 to 3 months of the last 2 to 3 months of each year, all of our clients are all given the opportunity to reach out to us, to run numbers, see if there's something else that can be done by the end of the year.
I like that you think about it in December, not April 10th.
Well, no, but
Too late
but
then.
it should be
Right.
thought at even in right after Labor Day. It should start. So
That's another sort of thing that we do in our practice that you won't find, I don't think, at these cookie cutter places, that we really encourage our client to utilize that service that we have, to do some preparation, right? So to speak, to make sure that maybe they've been, like, for example, paying New York State too much because their exemption in New York State was too high up until September. We might tell them, hey, change that with your employer and you're going to see a little bit more in your paycheck. And then because, you're essentially been lending them money or whatever it is, or maybe they're self-employed individuals and they've been like knocking it out of the park. We might be to them, say, hey, you're going to have a big surprise. You might want to up your fourth quarter payment because you've been doing so well. So there's different ways to look at it. But I definitely think a big refund, not a good thing. And I will say my dad does get excited when we've done all this planning for people and they come and do the return. And it's like, a few $100, $1,000 either way.
Well, that's another millennial
He
thing.
pats
They
himself
get
on the back.
very
and is so happy.
excited. Like millennials get very excited about a big tax return. Who's that? Larry's
my
phone.
But I'm not going
I
to.
wonder if that's good news or bad news.
It's probably
tax season.
Tax season.
Larry,
So,
do you want to get it? You can.
No, don't get it.
I don't want to get it. I don't like. A few things about me. One, I don't like cell phones, even though I respond.
Do you still have a flip
to them.
phone, or is that a real phone?
It's a real
Oh, okay.
cell phone. And the other thing that I refuse to do is I will not do business through emails. So
I would think in your profession that email would be better because it's on. You can verify.
We're very different here. So I embrace the technology. I've gotten our practice up to speed in technology. You can utilize. We have a secure portal that's 256-bit encrypt, where clients can use this free space to store whatever they want. If they want to send us something, I don't want you sending it over our regular email. There's too much risk for it in that way. If you're sending me financial documents, you upload it to our portal. I get a little tick. I can download it and take a look at it there. Clients can book appointments online. We have an online calendar. They can go in and do it themselves. We've set up where we're not sending as much paperwork in the mail. We're putting it to this online portal where things are scrubbed. You're not seeing social security numbers. I don't mind if a client wants to text me at 3 a.m. It's whether I reply then or not. But, in that sense, he and I greatly differ. I like to see things in writings. We're both pretty much type A personality, but, he wants things done yesterday. And with email, I think, it can get carried away, but I embrace it in our practice.
I don't.
There's nothing better than face to face. I get what you're saying.
I don't embrace emails because I always judge people by how they're talking to me, what their facial reactions are, and you don't get that through emails.
You don't. I'm not even good at writing emails. Natalie writes all the emails.
Natalie's emails are great.
They're so awesome.
Yeah.
I'm like, I couldn't do that.
Okay,
I need to talk. I'm good on the phone, but I'm not good with emails or in person.
I'm an old school kind of guy, although I started doing computerized tax returns in the mid 1980s, and in fact, we've been using the same tax program for over 20 years, since 1990.
I don't think you should give yourself like he's very good with computers. He could figure out stuff on computers that most people can't. So he's very technologically savvy. He just prefers to talk
I prefer
face to
to
face.
talk to
But in this
people.
day and age, that's not always possible. And
Well,
Right.
it is possible because
I know
you
you're
have
tech savvy
Skype.
because you showed me something. You had your new setup for your photos, which
Yeah.
I want you to talk about once we get to the end.
But
he has toys. Larry has toys.
I have a lot of toys, and I've always been a high tech kind of guy. And but there's nothing like looking at somebody's face. I have a good ability of reading people, and I love to read people. Like as an example, when a new client comes into our office, and by the way, we offer a brand new client a free consultation
Mm-hmm.
to see if they want to use us, and if we want to work with them. So
Because you're going to be I mean, Natalie and I are the same way with video production. It's like you end up, I feel like you guys are the same, where you get close to people, you spend time with them. You don't want to work with somebody who's, I don't have to finish that sentence. You got to feel good around them.
Yeah, you got to feel good
like
around.
If we have to trust what you're telling us is true, right?
Mhm.
And be able. And then there's numbers, and numbers don't lie. So if you're telling us something that the numbers don't match, or you're putting money, maybe running it through this business, and it's not actually for that business, we're going to question you on it, and we're not going to do what you want us to do if we don't truly believe that was the intent of what you're doing, because that opens us up to things as well.
I believe that people do small things the way they do big things.
Right.
So that's what you're talking about.
Let's just,
the way you live your day is the way you live your life. That sort of mentality.
Let's just also talk about tax returns,
Mm-hmm.
because something else that I've seen in my many years of being in this field is that when the electronic filing of tax returns became mandatory, I've still seen tax returns which are not electronically filed, and they are not signed by the tax return preparer. Now, we sign all of our tax returns. Our federal tax number and my social security number is on your tax return. Okay? If I don't feel good about your tax return, why would I want to put my social security number on your tax return? So if somebody wants to do your tax return for a ridiculously cheap price, and quite obviously, in life, you get what you pay for. So you should always question that and make sure that person's social security number and federal tax identification number is on your tax return as well.
Mm-hmm.
Okay.
Oh, I thought you were going more.
No.
It's funny what you're saying about being like audited in that process, because I remember I stopped working with somebody because he said it was like when I first started out, so I was working for him and he was paying me whatever. So he said to me, he sends me a text and he goes, "I just want to let you know that I just got audited." So it was almost like we were in the mafia. He's like, "So
this is the tax return guy?"
No, this is another person that does film. So he was paying me to do film, and he said, "Just so you know, I'm getting audited, so they might be looking at you." And like it was almost like he was sharing this with other people. So he was doing, I don't know what he was doing, but it was suspect. But I wasn't worried. Like it was like, why are you telling me like I need to be worried? I'm doing things the right way. But he made it seem like everybody else gets audited.
Here's what he meant. Number one,
nobody ever checked me, by the way.
This is a great tool that the IRS uses. They used to at least periodically do tax audits called on people who really shouldn't have been audited, just to set the seed of that person telling other people.
That's so interesting.
Put the fear in it.
That's what he did.
Put the fear in them.
It worked.
Now, that person may have told you this because of maybe you got revenue from this other company and you were working for them.
Right, I did.
Okay,
Yeah.
so here's the reason why.
Now he did not 1099 me,
What?
but it didn't mean that I didn't claim
No,
that.
no, no,
I
no,
claimed
no,
the
no.
income.
Jeff,
No,
this
no,
is
I was
we're
good on
taping
my end.
this, so
No,
you should.
you, no,
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 I'm. This is
no,
so
no.
long ago.
You no. Um, when the government comes in, and if there are subcontractors, I've seen them go to the subcontractors and check and see if they've picked up the income,
Let's see if it matched. Right.
especially if there are no 1099s filed.
Right.
Okay. Now in today's world, the government matches up all 1099 forms.
This
And-
is like his favorite. This is
Yeah,
this is a
driven-
bone to pick. I don't know if we should get into this with subcontractors and him.
Yeah.
We could get explicit.
Yeah, this is a really major.
I don't
Very
mind.
contentious.
This sounds
Very
exciting. I
contentious.
just got
Specific
like
well, it is
industries.
exciting. It is.
This
I
Exciting.
means
don't
we
know.
have another.
It's not going to be PC.
We have at least
We
another
just stop
30
it.
minutes of podcast.
Well,
so.
no.
That's what it sounds
No.
like.
The
second wind.
we have always been asked, one of the standard questions is, I don't want to file payroll taxes. I want to hire somebody and I want to put them on a 1099.
Mm-hmm.
What do you think? And I always tell people 100% of the time, never put anybody on a 1099 who is not a true subcontractor.
Right.
Okay.
That makes sense.
Now, but people don't want to pay the payroll taxes.
Now, one of the things you said to me, if that person's only income is the government looks at them as an employee,
as
correct?
an employee, and okay, bear in mind that the government wants all people who work for a company to be salaried employees. They don't want any 1099 people.
Because they know what you're doing.
Right. Now, there are a few things why I advise this. Number one, let's say that person leaves your employment and tries to collect unemployment. I could guarantee you all shit's going to break loose.
Mm-hmm.
On your side.
Mm-hmm.
They are going to say that they were fully employed by you. They are going to say that they worked more than 20 or 30 hours a week. They are going to say that they should have been a salaried employed person. And you're going to get into trouble doing that.
You might get away with it for a couple of years, right? But it's just that one person.
Second thing is that person gets hurt while working for you. And that person doesn't have their own insurance. You're dead.
Mm-hmm.
You have now put up at risk all of your personal assets for this. I just, getting okay back to what could I make and what could I lose?
Mm-hmm.
Okay. What you could lose in that situation is a lot.
It's just short-sighted.
It's just very short-sighted. So, and I've gone through quite a few payroll audits on where okay, New York State unemployment has come into a few of our clients and checked who is a true 1099, who is a W-2. And and I always advise people W-2, unless they are truly subcontractors, meaning that they will also work for various other people.
Right.
You do not have 100% control of them. You don't tell them when to work and where to work.
Mm-hmm.
They could work at 3:00 in the morning. Okay. You have no control over that. So that's what you should do.
Yeah, I guess it seemed like probably for a lot of people, it seemed like the quicker and easier, I don't know, business management, just say because 1099s are so easy to send out, but it's not taking in the full picture of what can happen.
No, it's not.
And a lot can happen.
Well, he was pretty nice. He only said one curse word,
Okay.
and I'm okay with it.
Okay. So,
so what else for this year do you think people need to know about taxes? What is something that they're not considering?
I think that what I've seen prior to this time, namely once the new tax act was passed, until the end of the year, when we've tried to do a lot of tax planning for people, and okay, even now, people have a fear of wanting to know what their situation is under the new tax act. Now,
change is scary.
Which
Yeah,
we
but-
actually told them last
Yeah,
year
but-
how they would look.
Yeah,
You
but-
said this is coming.
Yeah, this is coming.
But our tax software, which is the second most expensive tax software in the country, and had a module last year, or a built-in calculation, where when we did somebody's tax return for 2017, it would then take their 2017 tax return and calculate it under the new tax act, and you then see two separate columns. One's your actual tax return. The other one is what it then would have been under the new tax act.
Mm-hmm.
And now talking about the new tax act again.
That's a cool tool.
Yeah,
I like that you have that.
Yeah, but it's, I mean, if you're going to buy TurboTax and okay, do it on your own, it's not going to have it.
Right.
Okay. So one of the horrible things in the old tax act was something called the alternative minimum tax, which greatly affected maybe 2/3 of our practice, because what it is that this tax originally came into law back in 1969. I started working with it in 1970. And back then there were many multimillionaires who never paid any taxes due to their tax sheltered investments.
Loopholes.
Lawful loopholes, but still, if you did not make a lot of money, then you weren't going to take advantage of these loopholes.
Right.
So what the government did then is they then said, you're going to have to figure your tax based upon not being allowed certain tax write-offs, which are permitted under the regular tax calculation. So, and then there was an exclusion. So each then tax return had then two tax calculations, one under the regular tax and the other one under this alternative minimum tax.
The AMT. Probably heard that,
it's
right?
called.
No.
So
But the numbers they used in
haven't.
the
So-
70s for these sort of bands were never adjusted.
well,
And nobody really thought to look at them.
no. The exclusion was never adjusted by the government purposely due to inflation and due to the changes in the law and the fact that people are making much more money now than they did back in the mid-70s. So, I mean, when I started on my first job, I was making $9,000 a year back in 1971, a full-time job. So
That doesn't even get me through a
So-
month.
one of the items that you cannot write off in this alternative minimum tax calculation is your taxes. Namely, prior to the new tax act, all of your New York State taxes and all your real estate taxes were a full write-off on your regular tax calculation. Under the AMT tax calculation, it was not allowed. Medical expenses were not allowed.
Really?
Miscellaneous tax deductions were not allowed. Personal exemptions were not allowed. So there were
So if
a
you
lot
hit this
of
AMT, you didn't get the advantage of these
so
things.
Wow.
So there were a lot of people who began falling under this new tax as the years went on, basically in states like New York, Massachusetts, California. Okay. The higher,
Where it was high tax.
high tax.
Yeah.
So what then happened under the new tax act is now your tax write-off is now limited to $10,000, namely for federal tax purposes. If you've paid $100,000 in New York State income tax and $30,000 in real estate taxes, you can only write off $10,000. So that when you go through your alternative minimum tax calculation, your then disallowance under the new tax act is only $10,000, and many people aren't going to be subject to that anymore.
Mm-hmm.
Okay. Now,
It was basically thrown out the window.
Now, further, why is the government always kept this tax in the law? Well, they've always kept it in the law because it was a great revenue producer. And you can never tell Washington, or at least our so-called political leaders, to stop spending money.
That's right.
They will always spend as much as they have. And
Washington's
more,
not going to tell you we've been taking
more.
too much money.
They will
right?
spend more than what they raise.
They do.
But
So-
what I think my dad is alluding to is that these states that we spoke about before were basically funding the entire United States, right?
Mm.
Yeah, so-
through their taxes, and now this
Because that's where all the money was.
that's
too.
where all the money
Right.
was. And this concept of the AMT is under the new there is no AMT anymore.
Well, it's severely restricted, but prior
So
to
that
the-
affects who then?
So
that-
if we looked
Is
at
that
the old,
everybody, or
if we looked at the
No,
old, if you
no,
hit
it's
the
not
AMT in say 2017 under the new tax act, all things being equal, you should do better, i.e. pay less taxes because you didn't hit this unadjusted sort of income band that disallowed all these write-offs.
Right.
So if you are in these tax brackets, then you should
no, but
do better because you don't lose.
well,
these.
but okay, here is the difference. You will do better under the new tax act, but not as well as you would have done if there was no alternative minimum tax.
Mhm.
That's the kicker. So that if there was no alternative minimum tax and your total taxes were 50,000, but due to you falling under the alternative minimum tax, your taxes are 60,000.
Mm-hmm.
And okay, under the new tax act, your then taxes would have been fell to 40,000. You were still better off, even though you paid the alternative minimum tax. But if there was no alternative minimum tax, then you would have been rightfully much better off. So there's a little caveat there.
But they also sort of, they adjusted the tax brackets as well. So you're 2%, each tax bracket is basically moved down 2%.
As somebody I was listening to was saying, and it like some of this terminology people say, you wonder what it really means. So they were saying this person lives in California, and they said my effective tax rate is 45%.
What that means?
What are they talking about?
Okay, what that means is that the last dollar that you make, how much is being taxed?
When all things said and done, and
the last dollar,
100,000 came in,
dollar,
I
not
paid.
no.
Oh,
The last dollar, not your total tax
Not your
rate.
marginal.
gotcha. Okay. Because that sounded high to me when he said 45%.
Yeah, but think about 1970, 70%. Prior to 1970.
No matter what you made, it was 70%.
No. Passive income. No.
I'm just talking about just a tax in general.
It used to be 70% on all types of income.
Because I heard in the same time there was, on the ultra rich, it was 91% or something
it used to
like
be
that.
over 90%. But then what happened is that that the government came into a new tax calculation in the 80s called the maximum tax, where they subject all earned income like salary income to a 50% tax bracket, and all passive income like dividend income to a 70% tax bracket.
Mm-hmm.
So, but of course that isn't the law anymore. But I really believe that this is the biggest tax change since 1986.
And this is good for business.
I think it's good for business.
If you're upfront with the government, if you do things the right way.
I think it's well.
I think there's the jury's still out to see if the government, the workers, and understand the law. I think there's going to be a lot of confusion.
Well,
Sure.
You're saying there's going to be a lot of audits?
No. I'm saying there will be less audits. But let's also talk briefly on doing things the right way. Okay. I've had people come into me and say, well, I make $40,000 a year in cash and I'm not claiming it. And my response is, well, then you need to get another accountant, because I'm not putting my social security number on your tax return when I know this.
I don't think a lot of accountants would say that.
Okay. Now,
yeah.
Second of all, I always advise people to report.
Why would they even tell you that? Sorry. Is that the Italian side of my brain was like, don't tell people.
You should be surprised at what people tell us.
Well, and I further always advise people to report all their income. Mm-hmm. Why? Not only because you could get into some serious trouble if you don't, but people who hoard cash tend to not use that cash wisely, and to not invest it, and to spend it on stupid things, mm-hmm. and to not make their net worth better.
Right.
Now, I think another in that sort of, you get paid in cash, they're not thinking about the future and getting into financial planning and investment management. Like, you have to pay, you want to get a Social Security check? Social Security you have to pay into it.
Right.
So if you're, maybe taking care of kids and they're just paying you on the side, you're never going to get, and you're a citizen or not, you're never going to get a Social Security check or until you start paying into it. They don't even know you're working.
And we were talking about getting a mortgage, how things have changed. If you don't show that you have some income or that your income's higher,
it's not going to happen. I mean, there's reasons people do that. They need health care and there's other things going on.
Sure.
But getting paid in cash, you want to ever retire and get money from the government in the form of Social Security, that's not going to happen.
Well, it isn't even Social Security. It's the fact that you're
just kind of talking about just being honest.
Well, it's the fact that you also aren't setting up private retirement plans, doing maximum contributions for those, and just spending the money on stupid things that you wouldn't spend it on if that money was legal.
Mm-hmm.
And I've never seen a situation where that person was better off doing it the non-legal way.
Right.
Now, so besides it being against the law and the fact that you could get into some serious trouble, it's not to your advantage.
Mm-hmm.
Now,
IRS is going to get its money.
Now, further,
one way or the other.
Further, I have seen many people who I can say this till I'm blue in the face, and they will not change, because it's a way of life.
Right.
This is what you learn from your parents.
Yes.
And this is what you're going to do. And you know what? Best of luck. I'll see you around. Hopefully you won't wind up in jail. So good luck with your life.
Yeah, tax evasion is not taken lightly.
Well, it's not. And what did What did Al Capone get nailed on?
That's right. No, he never got busted for his criminal activity.
He never
in
got
terms of the
busted
mob
for his criminal
It was tax
activities.
evasion.
Tax evasion.
That's how they got him.
He spent time in Alcatraz for tax evasion.
The same thing with the guy, Natalie, was his name Frank White? He is the biggest heroin dealer of our time in the 80s. It's Frank Wright or no, Frank,
The guy from The Departed.
not from The Departed.
Folger?
No, he was in the Denzel Washington played the guy.
Oh yeah, from Harlem.
Frank something. I
Frank
forget his
something.
name.
Yeah, no, I know who he is.
But so same thing. So he was making $1 million cash every day from heroin.
No,
he was making $365 million.
No, but what?
But they didn't even know about him. Hold on, wait. He wore a mink coat to a boxing fight, and there were some federal officials there, and they just checked. They said, "Wait a minute, how could he afford that jacket?" Or was his wife?
Okay, but
that's what he got busted for. Never
think
heroin.
about how you get caught. I'm going to give you an example. Goodfellas, great movie, right?
Awesome movie. I just watched it the other day.
Awesome movie, but there was one scene there that relates to this. Robert De Niro does this great robbery over at what they called then LaGuardia Airport.
A great robbery.
A great robbery. It was one of the greatest robberies of all time. And he's in this bar, and they're all celebrating.
At that point, it was the largest cash bank robbery ever.
And they're all in this bar, and they're drinking, and they're celebrating. And one of the guys who was on the robbery, his girlfriend came in with a beautiful new mink coat. You remember that?
He walks in. He's like, "Take it off right now. Go return it right now. What did I tell you about buying new stuff?" And then the other guy comes up with like a Cadillac, and he's like, "Get out of here. Go return."
And what these people do who don't report everything is one of the ways that you could get caught is you spend this money on things that do not parallel what you are legally making. What are you going to do with the money? Are you going to go into a new car dealership and put down $50,000 in cash for a new car? He won't take the money. How are you going to make it legal?
Spoiler alert: Robert De Niro had all those people killed in that movie because he knew it was his ass. He knew
that was the way to get caught.
That's right. That's right. That's crazy.
You like that, huh?
Oh, I love it. That's such a great movie. Obviously, I love De Niro.
But think about that scene.
Yeah, because he was smart. He understood. They said, "Don't buy anything big. $100,000 mink coat, $20,000 cars.
Don't change your. Do not enjoy your money."
Well, even
if you want to not enjoy it,
even the same thing. Not that we're trying
to your mattress.
Not that we're trying to talk about criminal activity, but El Chapo is in court right now.
Yeah.
So I know they're fighting on the same thing, and it's just like, where did all this cash came from? Like, they're following the money, which I think is really what the government does.
Okay, are we done? We just have to go back to tax season.
I know I think we're done. I really enjoyed.
It's only been
almost 2 hours.
Do you want me to talk a little bit about my real passion in life?
I want you to talk about, because while we were filming your video.
Do you want to talk about it, Dad?
Yeah, he wants to. I just want you to mention it and talk about it a little bit, because I just think it's important. Like, so I do this podcast, Larry, because my brain gets bored, and I like to be creative and do other things. So you spend a lot of your life in numbers and stuff, and now it's called Larry's Eyes is your website, right?
Right.
And it's doing photography and travel. So I just want to mention today, it's interesting that I'm talking to you because you do a lot of traveling and photography. So 2 years to the day, for me, I was on the top of Mount Kilimanjaro. It was 2 years today, and it's fitting that it's freezing cold because I'm like reliving what it was like to walk up that mountain. But there's something about traveling and documenting your traveling process with photos or videos.
Right. Well,
so what are you up to right now with Larry's Eyes?
Well, first I'll just give you a brief thing about I travel around the world, go to very unique places, taking pictures of the way people live, and I try to get fully saturated in those various cultures.
And it's not just a photo. You usually write something.
On my website, you will see a blog section. Every day I travel, I write a daily travel blog. I have a lot of subscribers now. People love my writing. People love my photography. Getting back to the high tech world that we live in today. Well, when I was a kid in the 1950s, one of the few high tech things, and it really wasn't, was this little film camera called a Instamatic, and I used to have one. And on my bucket list was to travel around the world and then take pictures. Well,
This was a thought of yours when you were a kid.
When I
didn't know that.
When I was under 10. Then, I then gave it up for over 50.
I didn't know that either.
I then gave it up for over 50 years because of family issues, going to school, trying to make money, trying to find myself in life.
Yeah, I don't even know how you get into taxes. Nobody, no 10-year-old says, I want to be an accountant. Maybe
I
Lindsay.
then back in 2004, when digital photography was in its infancy, one of my best friends dragged me up to a camera store in Connecticut, and I bought a very primitive digital camera. And I learned how to take pictures in the digital world. And I'm not going to get into what you need to do to make you a great photographer, but if you like, you could, of course, go on my website, look at it. If you like it, you can subscribe to it for free. I am having a presentation of my work in a place called the Cortland Dance Studio. I will be there tomorrow between 3 and 6 o'clock.
That's February 2nd from 3 to 6.
February 2nd. All of the pictures will be hanging there for at least a month, and if you'd like to send me any comments or any questions, you could always contact me either through our business website or through larryseyes.com.
So your business website, just so people know, because we'll just wrap it up here, llfinancialservices.com. Right? I have that right?
Yep.
llfinancialservices.com. Yeah. That's Larry and Lindsay, Lawrence and Lindsay.
Yeah.
Is it larryseyes.com or what is it?
Larryseyes.com.
Larryseyes.com for the photo. You guys also give back to the community. So I just want to mention we're doing the comedy show is it just youth lacrosse or is it girls lacrosse?
No, it's girls and boys. It's the Brackliff Manor Youth Lacrosse League.
So I think that's fun. You guys are going to get to see my comedy. I told you it's not.
Also the Peekskill Art Center I'm involved with.
Oh, I didn't know that.
Yeah. So
cool.
We're up here in Peekskill as well, helping out, and down in all of northern Westchester. My parents do a lot of philanthropic work, and they're heavily involved. My mom is a dentist in the area, and she goes through and sets up dental clinics in poverty-stricken areas, and provides free service for kids and even adults. Now they've opened up to who would have never seen a dentist before. She does that sort of all over the world.
That's what I've learned in my travels, because I've volunteered and been on the boards of nonprofits. You just realize that just something like running water, or having a toothbrush.
Right.
We had donated 10,000 toothbrushes to the community, and I mean they didn't even really. I don't want to say they don't know what it is, but they use it on their teeth once, and then they use it to clean their cars, whatever they have. It's something else. So
well, I'll give you
maybe that's why we are kindred spirits.
I think I should just end my part of this conversation by saying in 2005, on my first trip to Cambodia, I've been there 9 times for philanthropy work, and I spent a week and a half in a rural village in northern Cambodia on the border with Thailand in May of that year. And no running water, no electricity, slept under a mosquito net. And when I came back to America.
Well, you did teach those kids how to play baseball.
I did.
Good for you.
I ran a baseball camp
we rallied up all this baseball equipment, sent it over there.
Yeah.
That's so cool.
Yeah. And
I got to hook you up with another guy. He does, it's Gear for Goals. So he does, we brought sports equipment to Kenya, Dominican Republic.
Yeah, you got to tell me about that.
Yeah. You guys be into that.
Yeah. But what wound up happening is that when I got back to America, I was emotionally a cultural basket case. I was torn between seeing what I saw, living in what I saw, and here in America. So the following day, I went to a local supermarket, and I was walking down one of the food aisles, and there was 100 varieties of cereal, and I started to cry because what we have in this country is so unique, and people take advantage of it, and they don't understand how we live and how precious that is.
It's so interesting what that does when you go to a third world country. Because, you know, I do presentations for kids in middle school. So, I was just in Rye last week. And I wasn't there to tell them and like talk down to them and say, you're privileged and all this stuff, even though they are. But just to say, like, I'm not trying to make you feel guilty about what you have, but just to appreciate it, just to like reflect and be aware that you don't have to feel bad for what you have, but just understand you have this opportunity that most people don't have.
Just the simplest things.
I mean, people don't even understand, like 80% of the world lives on $1 or less a day.
Just the
80% of the world. It's mind blowing.
Yeah.
So we got it good.
Okay.
We
All
do
right.
get it.
Guys, thank you so much. We're done. I told you that was going to be
Thank
easy.
you.
Thank you.
Thanks for having us.
So how'd it go? You guys did great.